Hello, everyone. Welcome to the final bar. Here we're looking at a market coming off after yesterday's sell-off after the Fed meeting and Fed announcement, getting a little bit of weakness here with the market really chopping around for most of the time, but pretty much everything finishing the day lower than it started yesterday. So we're going to look at some of those long-term themes. My guest today, David Auerbach from the Daily REITBeat, is going to share with us some thoughts about income investing, which I think is really timely right now when we think about potential for downside, locking in gains, and looking for income opportunities when rates are at all-time lows. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the lenses of technical analysis, data visualization, behavioral finance, investor psychology, all the tools we can bring to bear to understand where people are placing their bets and how their emotional state, how the emotions of fear and greed that motivate buying and selling, where we can quantify those feelings, and how they're expressed in the form of price. As we've talked about a number of times, right? The practice of macro charting analysis, in my opinion, is driven on three steps, right? It's price, then breadth, then sentiment. We're going to hit on all three of those in today's show, but it starts with price, and it's all about the S&P that continues to come up, but it's all about some key support levels and what's able to hold above these 50-day moving averages, where you see the FANG stocks, you see the XLK, the S&P 500, all sort of teasing that ascending 50-day moving average. I think the question is going to be which hold up and which break down through that. It's going to tell you a lot about what to expect in the coming weeks and months. Now, we have a great guest today, David Auerbach. Excited to have him back on the show. Really focuses on income generating investments, including real estate and elsewhere. Coming up next week, we have three excellent guests as well. Tim Brackett from the Markets Compass is joining us on Tuesday. On Wednesday, the 23rd, Leslie Juflas from Trading Live Online. And then on Thursday, Todd Sohn joining us from Strategas, one of the technical analysts there. Also, next Tuesday, we are putting the final touches on our big launch event called Introducing StockCharts ACP. I was just checking out recently the interview that our founder, Chip Anderson, did with Martin Pring earlier this week. We've sat down with John Murphy, Larry Williams, Ralph Atkimpora, Dave Landry, Arthur Hill, just a fantastic, Miss Schneider, just a fantastic group of analysts, traders, successful investors sharing their journey of using technical analysis. And then we're going to share with you ACP, our new charting platform. Again, sits on top of all of the StockCharts tools you're probably familiar with, but gives just another level of dynamic-oriented ways of engaging with the markets in a very fluid, very effective way. So coming up on Tuesday, the 22nd, introducing StockCharts ACP. Let's get to our market recap. So as I mentioned in the introduction, right, markets coming off today, and really, not surprised given the way that yesterday, sort of ended up. You had the selling coming after the Fed meeting and really Powell's press conference, and you sort of felt that any sort of waiting and seeing was sort of ready to be done, and any profit taking, any selling that was holding up to see what the Fed might do to surprise one way or the other. I think that was pretty much it, and now it opened the way for selling today. And as we've talked about up until now, you probably get the sense that I'm certainly more cautionary than optimistic at this point, given the weakening breadth characteristics. And I just spoke to University of Richmond. They have a class on technical analysis. And Greg Sabo does a really good job there, the professor leading these students through, really the building blocks of technical analysis. So I spoke with them for a couple hours last night, and we spent a lot of time just looking at the breadth chart that we've all talked about many, many times, which is essentially looking at the weakening breadth characteristics and how that indicates internal weakness. And just to stress the point that we're making, if you look at the January to February peak, you have higher highs in price. You have the S&P advanced decline line making higher peaks, But if you look at the NYSE common stocks, if you look at the mid cap index, if you look at the small cap index, none of those confirming the new highs in February, all of them sort of making lower highs. Look at where we're at now. And again, I don't think this necessarily means you have a replay of February to March, although it certainly could, but I definitely would think it tells me to think more about risk management than risk appetite, and thinking more about the potential for something closer to this than what we've seen in the last 5 months or so. And again, to point at the evidence, right? The S&P advanced decline making higher highs along with the price, but all the other Brent indicators rolling lower. So what this tells me is a couple things. Number one, the broad indexes are getting weaker, and it's not just the mega cap stocks. These are equal weighted measures of advancers, decliners going down the cap tier. So it's the average stock that's actually rolling over as well. It's not just Microsoft and Amazon that are starting to pull back a little bit. It also tells me that the conditions are ripe for, a market topping pattern more than what we've seen. I would not say what we've seen so far is enough to classify this as any sort of longer term top. It's really looking a lot more like the June peak so far. You need to break down through the 50-day, start seeing some things follow through to the downside, start seeing some, much deeper profit taking some of the larger names to call it more of a top. But again, the breadth conditions are similar to what I've seen at previous tops, and that tells me to start thinking defensively. So as we think defensively, what does that actually mean? Well, I think number one, it's got to be a focus on price, or you got to focus on price, which is number one. Then you qualify that with breadth and you color that with sentiment, and that gives you your total picture. The S&P has not broken its 50-day moving average. It traded below it earlier today, just like it did last week, but did not close below it, and that's sort of the first step you would look for. So, 33.50 still holding as a support level. If and when it breaks down through there, which I think fairly safe to say it will, I will be looking down here around 3,200 to 3,250, and I really think 3,200 is going to end up being a really good place to look at. That's the low from July. That's after we broke above the June highs and pulled back. I think that's a really good place because especially on the weekly chart, that's going to look like a very clear support level. That's your first objective. I think as long as we remain above 3,200, I think you could argue that this sort of primary trend still remains positive. If and when we would break that, I think you really have to start looking at some of these other support levels, start looking at names and where they're breaking down of key levels. And again, for that to happen, it's going to be things like the FANG stocks are going to have to break down a lot further than what we've seen up until this point. Let's look elsewhere. We're going to talk a little bit later in a segment called Getting Sentimental. We're going to focus on some sentiment indicators like volatility and put call ratios. So I want to hold off on that, but let's just hit on the main points of evidence using price. The S&P down about 0.8% to 33.57. Mid caps and small caps down as well, not quite as much as the S&P though. The Nasdaq 100 really leading the way lower, and even though tech was about the middle of the road, it was about in line with the market today. Other sectors really that are represented in the Nasdaq, things like communication services really dragged it down. VIX actually went higher, right? So an increase in volatility up to around 2650. In terms of some other asset classes, bonds finished a little bit stronger, although it gave back a lot of the early gains through the course of the day. The dollar weaker, and it sort of opened up, but then slowly, stepwise motion made its way lower. So we talked earlier about the bullish divergence with lower lows in the dollar and higher lows. Certainly didn't get upside follow through today, although I still think that's an a general theme that I think we're going to be dealing with going forward. Gold actually finished lower. That was a big gap down, and it closed more toward the highs of the day, although still that's down from yesterday. So a bit of buying coming in during the course of the trading day. Materials we've talked about, and recent guests have focused on things like materials, on industrials, on some of these cyclical, markets that's sort of coming back. Energy as well, number 3, and energy has been a perennial, bottom of the pile list where you see, weakness. Even on days when materials and industrials increasing, you're seeing energy a little lower. This was literally the MEI trade at the top of the list, 1, 2, 3, which really speaks to a leadership rotation away from some of the things that got us here into some other things. And again, the charts in materials and the charts in industrial, they're looking at individual stocks and where you're seeing emerging strength. I would not, I'd certainly be focusing on those two sectors for some clear opportunities of what's going on here. Real estate was actually the bottom of the list here, and it's interesting to see utilities and real estate. There are times, again, regardless of the broad market environment, it could, it's a play on interest rates because it It speaks to the income, component to those sectors. But it'd be interesting to see a rotation into some of those higher yielding sectors, things like utilities, things like real estate for sure. You see those bubble up if and when you see further downside. I think that'd be safe to say you'd see some of that rotation as well. In terms of particular sectors and in particular industries that have gone up, it's a little bit of a mixed bag, actually. 3 of the top 10 were in industrials, 3 of the top 10 in materials. So not surprising that those are the 2 top sectors. And again, I think with materials in particular, a lot of people sort of write that off and just think of it as like gold and mining stocks. And remember, materials is actually relatively diverse. 3 of the top sectors, you had non-ferrous metals, that's fine. You have steel names in the top 10, paper stocks in the top 10. So it's worth looking at what we call the industry summary page. It allows you to drill into a sector and look at some of the types of companies that make up those sectors. And if you're not familiar with some of those, I'd encourage you to dig in a little deeper. It's a great opportunity to look for pockets of performance that you might be surprised to see. One other check-in on breadth here very quickly before we bring on our guest, David Auerbach. And I just wanted to hit on, we talked about the breadth in the form of the cumulative advanced decline lines. The very last thing I would say as we're thinking about potential downside risk is look at the percent of stocks above their moving averages. And this is the key one down here. This is not updated yet through today's close, but I'll be very interested to see as this comes off, is it able to hold 50%, which means at least half of the stocks in the S&P remain above the 50-day moving average. And that's one key benchmark to look at. We need to take a quick break. Back with my guest, David Auerbach. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We love to hear from you. Feedback on the show, what we could do better, what we could do differently, but especially questions that you're running into as you go through this journey of analyzing the markets using charts, data visualization, technical analysis. Get your questions to us a couple different ways. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV. And any of our YouTube videos that you see on our channel, go ahead and just put a comment underneath. We get some fantastic comments in each one of those venues. We'd love to hear from you, and I'd be happy to answer one of your questions on the air tomorrow, which will be our next mailbag segment. I want to welcome on my guest, David Auerbach. David authors the Daily REITBeat. I think of David when I think of income, when I think of low interest rates and where I might want to go. I think of some of my conversations with David. David, you and I first met back in February at a conference, and the whole idea of a conference feels like many years ago. It wasn't that long ago. It's February, but it's really good to have you back on the show. Hope things are good your way.
Dave, thanks so much for having me. It's great to be with you and your listeners today. I'm so happy to be here.
So we have this I'm super glad that you're on the show today, because we have this sort of mix of the market threatening or certainly getting people thinking about potential for downside, and some of the high flying sectors, tech and others, that have got us here. The question is, are they able to hold up? And if not, if things start to get a little uglier in a low interest rate environment, what do you do? Like where do you start to focus? You've brought a couple charts with you, but I'd love for you to take it away. Where should we be looking now?
You know, I personally come from a REIT and ETF background, and thinking about the landscape of real estate, knowing how the grocery stores still have people shopping, people are still going to Starbucks. People are slowly trickling back into the office in certain segments. They're storing more stuff. There is a demand in the portfolio for a slice of real estate. And in a call it a 0 to a less than 1% interest rate environment that we're living in, REITs are a good safe haven to be in, because right now, according to NAREIT, the average REIT dividend yields at around 4%. So you're being paid an average of 4% before any upside appreciation in some of these stock prices. That, it's a good way to store some capital. And I see that the first chart we have up here is a company called Fundamental Income Net Lease Real Estate ETF. The ticker is NETL. NETL is a great example. It started by 2 executives that used to be at Store Capital out of Phoenix, Arizona. Mm-hmm. And Store Capital is a Berkshire Hathaway stock held investment. So obviously if Warren Buffett believes in them, obviously these guys know what they're doing. And they left Store to launch a net lease platform. And this is interesting. It's got about $47 million under management. They came out in March of last year, 2019. It has 24 net lease REITs under the portfolio. And for those that don't know, like a net lease would be something that would be like an out parcel of a shopping center, or it'd be like a 7-Eleven, a gas station, a Starbucks, a gym. You know, it's just a very interesting property. And right now, since we're in a lower for the longer rate environment, the demand for income is becoming more insatiable, and net lease REITs are a great way to invest in America. This particular ETF is a hybrid between a fixed income and equity exposure, looking at long-term corporate cash flows, and it's all secured by tangible assets. Again, it's the gas stations, it's the 7-Elevens of the world. It's got about a 4.5% current yield right now. It's down about 10% year to date, 9% year to date, but it's up off its lows since the middle of March, up 70%. So, you know, it's had a nice ride. And again, for, you know, thinking about how people are continuing to go to Starbucks as an example, these guys are getting their rent paid. And that's one way that a lot of these people are focusing on the REITs, is how much rent are you collecting? You look at the strip centers, you look at the malls versus, you know, one of the companies we're going to talk about that has 100% rent collection. So it's a really interesting way to store some cash. Another one,
from a technical perspective, it's actually interesting. It's sort of creating a base over the last 3 months, sort of testing the upper end of that, which is compelling, and back above the 200-day moving average, which is interesting as well. Chart number 2 is the InfraCap REIT preferred ETF. Our friends at InfraCap. But tell us about this one.
This is a really unique real estate ETF. So this is a REIT preferred ETF. Its biggest competitor would be what's called PFF. And if you go back to COVID, prior to COVID, PFFR was outperforming PFF by about 1.25% annually. So this particular ETF has about a 6.6% yield. It's paying right now currently a 12-cent monthly dividend. So, you know, it's got 97 holdings, and a lot of the holdings, it's a very diversified portfolio. So it does own a bunch of strip centers and malls. But what's interesting is they've taken a look at some of the trouble type companies. You know, so if there's a JCPenney exposure, or a company that's got exposure right now to some of these troubled tenants, you know, they've kicked it out of the portfolio. So it doesn't have a troubled mall like a CBL as an example. It's got about $52 million under management. It came out in February of 17. It also is down about 11% year to date, but it's up almost 84% off the March lows, as your chart shows here as well. And again, for those that don't know, preferred stocks, you know, you're getting paid a little bit more on the dividend yield. There's an extra, you know, depending on the name and the company and the quality, call it 100 to 200 basis points of incentive for you to participate in the preferreds. It may not run up as much as some of the commons might, but you're getting paid for safety. And also, in the event of a default or should something happen to the company, you're higher up in the capital stack, so you have a chance to receive. In addition, another great thing about preferred stocks, should they postpone their dividends or pause their dividends, the dividends accumulate and called dividends in arrears. So when they do get turned back on, you're paid all the accrued dividends that you're owed. So it's a really interesting portfolio. And again, across 97 securities, you are pretty well diversified, where you're not putting all your eggs in one basket.
It's a great take, David. We're out of time. This was a lot of fun. I'd love to have you back on again soon to get some other ideas, especially, again, given the interest rate environment. Some of these higher yielding and the two charts you've given us are actually in pretty decent shape on a price basis. So a lot to think about. David Auerbach, thank you so much for coming back on the show. Hope you and everyone around you stay safe. All right.
Thanks, Dave. Appreciate it much.
That was David Auerbach joining us. He's the author of the Daily REITBeat. And again, I first met David earlier this year and have enjoyed keeping in touch with him. You know, REITs and the whole real estate sector, if you know your market history, right? I don't remember how long, it's 5-6 years ago, I want to say. Real estate as a sector was actually included in financials, and then sort of peeled off and became its own S&P sector. It's why we have the 11 S&P sectors now. And it's interesting. I think a lot of people just think of real estate as one asset class. And talking with Dave, I've realized it's actually a relatively diverse sector. There are a lot of different levers that you're pulling if you're looking at real estate, but one consistent thing is the higher yield. And again, as an income-oriented investor, if that's how you describe yourself, may certainly be worth taking a second look. Our next segment is called Getting Sentimental. So we love to talk about price and breadth and sentiment. Those are the three pieces that I focus on as a macro technical investor. Price is number one in importance always. Second to that is breadth, which is really qualifying, is really trying to break down the price movements, look under the hood a little bit and see what the companies that make up the broader indexes, what those are actually doing. The third piece to the puzzle for me is sentiment. And some sentiment indicators I find more value than others. In general, I tend to think of them as more anecdotal. And what I mean is what I see in sentiment is interesting, and it always leads me to look deeper at price and breadth. And that's why I find it to be so valuable. If you think about contrary opinion, you read some of the great books like Humphrey Neal's on contrary thinking and others, you'll see comments about looking at magazine covers. And I know for my time at Fidelity, we have this beautiful wall-sized chart with magazine covers, and it's amazing how major market tops and bottoms would be they're coinciding with those peaks and valleys. You would have magazine covers that would express the contrary opinion, right? When the market rips to the upside, you get these, markets going to the moon, Dow 100,000 type of covers, and that usually is the end of the move when a magazine picks up that sort of thing. Sentiment is all about trying to get inside the head of the masses and what is going to motivate investors to make their decisions. So let's walk through a couple of ways we look at sentiment, just update them where they're at, because a lot of them sort of come out on Wednesdays and Thursdays. So it's sort of a good time on a Thursday afternoon to reflect on where they've been, where they're coming from. So when you look at the VIX, there's a traditional assumption that stronger stocks means weaker volatility, weaker stocks means stronger volatility. And if you look over time, in general, that has certainly been the case, right? There's in general, an inverse relationship here between the VIX, the volatility index going up, and the S&P going down, and the opposite when stocks are appreciating, the VIX tends to go down. But it is not a one-on-one correlation. There are times when, especially on a shorter term time frame, where you will see both stocks and volatility increasing, and sort of the end of August, second half of August is one of those examples, right? You can see the VIX actually increasing here to peak the first week in September, just like we did with stocks. So on certain timeframes, you actually see them moving together, and those correlations are no longer perfectly negative or close to that. The reason why that is again, just like we think of an inverse relationship between the two, they're not directly tied to one another, right? The VIX index is actually looking at options and volatility on the options that are related to the broad index, but not 100% to them. And it's put and call options all mixed together. And so, the idea of this, people call this the fear gauge, because the higher the VIX, the higher the volatility. When people are kind of calm and slowly accumulating shares in the market, you don't think of that as a volatile environment. You think of that as relatively low volatility, as people are sort of chipping away, like here, fourth quarter of 2019. When people start panicking, that's when volatility goes up, and that's why you think of it, and that's why you tend to have tops in the VIX coinciding with bottoms in price. So where we're at now, well, we moved inversely up until about a month ago, and mid-August to the first week in September, you sort of went back, and since then they've actually been pretty closely related. Overall, though, I think the trend you want to be looking at as you look at the 50-day moving average on the VIX is the fact that it broke above its 50-day here at the end of August, now sort of coming back here, and potentially, if that holds, you see we've now rotated from a downtrend in the VIX to an uptrend in the VIX, and stronger VIX, generally speaking, means weaker trend. So I think seeing the 50-day hold here for the VIX and seeing higher highs and higher lows, which we may be seeing this week, coinciding with a breakdown of the 50-day, I think would sort of confirm increase in volatility, increase in uncertainty. And if we do break down through 3,300 and it's clear that those early September lows are not going to hold, and that first sell-off was the first of multiple sell-offs, I think you'll see volatility spike very quickly, and that'll speak to the uncertainty. Interesting move in the AAII survey. Actually, last week had gone fairly negative with about a 2-to-1 ratio of bears to bulls. That's actually reversed pretty quickly. So it's interesting on the last weeks. This is coming off of the sell-off last week. Now this week we have a sort of holding steady in there. You can see the bulls actually reclaimed, and we're again still favoring bears over bulls by about 8%, but overall a little closer to even, actually closer to even than we've been in quite a while. This is sort of the closest we've gotten to the zero line, going back here for the last 6 months, really since the market sell-off February through March. So if and when you'd actually see a positive turn in this AAII survey, for me, that would indicate there's enough optimism to propel the market to further highs. Until then, I mean, it certainly speaks again on this subset of investors that there's not the euphoria that might, or not the optimism, maybe another way to put it, that would suggest further highs maybe in store for us. A bit of an increase here in the name exposure index, which is interesting. This came off, it was over 100%. This is active investment managers and where they're leaning into equities or away from equities. In the last 2 weeks, you saw a huge decline to almost 50% last week, increased back up to around 59%, which just suggests some active managers coming back into the markets just a little bit if they came off of it. The REITex flows are still remaining in a relatively low level, essentially fairly bullishly positioned there. Finally, we have the put call ratio, and I think the story here is the extreme lows that you had at the end of April, end of August, going into the beginning of September. It's come up quite a bit, with this sell-off. But overall, I think that's really the key signal to pay attention to. The extreme low in the put call ratio really speaks to the extreme. And if you look back in market history, those are the levels that tend to line up with previous market peaks. So I'm not seeing anything in the chart that would tell me to think of that as anything differently. It's sort of providing a piece of evidence suggesting late August, early September. That was sort of the peak, the low in the put call ratio peak in stocks. That's our look at sentiment, just trying to hit on some of the key themes. And again, for me, everything we just talked about is compelling, but for me, it's most important to take that back into analysis of price and breadth and see how they relate. We need to wrap the show and go to the 3 and 3 charts, 3 minutes. Here we go. We talked with David Auerbach today about REITs, and again, I'd encourage you to look across sectors, because I always find there are some sectors you're more familiar with as an investor, and for a lot of individual investors, it tends to be consumer products, technology, stuff you use. You don't use REITs a lot, or if you do, you don't know it. It's the stores you go into, it's the malls you might go to, it's the strip mall, it's the office you use. These are all the things that REITs actually have exposure to. So I'd encourage you to take a look, but the one thing I would tell you to look at is technology. And as we think about differentiating a market pullback and then a resumption of the uptrend, or this is leg one of multiple legs down, the relative strength in the XLK and its ability to hold its 50-day moving average, I think, is really key. As you can see, arguably the relative strength has broken down through its first trend line support for the first time really since going back here, the market low in 2018 in December. And so a rotation away from technology, I think, would be certainly significant. The way we get there is indexes like this breakdown. We talked yesterday with Patrick Ceresna about the FANG stocks, right? The FANG man, MAGA, whatever we want to call that group of stocks, the leadership in tech, consumer and communication services. The New York FANG Plus Index has not broken its 50-day moving average. If it breaks below 5,000, which would be the swing low after the pullback last week, I think break below 5,000, a break below the 50-day, that you will see an influx of selling or a drying up of buying as people start to recognize that there's further weakness potentially for those previous leadership names. And where is money going? To be honest with you, it's going into things like materials and industrials. And again, the XLB, I think a lot of people have thought of that as sort of a rounding error sector. It's just a couple percent. It's so small relative to the other sectors, but you can't deny the relative performance. And really since early April, materials have been doing pretty well. A lot of that most valuable outperformance has come really since the beginning of September, when certainly people are putting their bets on materials, making another 52-week closing high today, which is something to be impressed about. So continuing to look at the RRG charts, how things are rotating, especially further into materials and industrials. That's a pattern I would look to see if it continues. Folks, that's our show for today on a Thursday afternoon. Thank you so much for joining us. As a reminder, every Friday we wrap the week, so it's one of my favorite shows. Great way to finish up the week and look at how things have changed Friday to Friday. Special thanks to my guest, David Auerbach from the Daily REITBeat, for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.